What if I told you that the digital asset market is not a random casino designed for internet gamblers, but a structured wealth extraction machine, where passive consumers consistently fund the early producers? Welcome to Money's Hidden Past, Rich People Lied. We fact-check today. We are stripping down the mechanics of the blockchain and exposing the exact assets that minted overnight fortunes. Most retail investors approach this market as consumers. They frantically chase green candles and buy the peak, providing exit liquidity for institutional capital before watching their portfolios collapse into nothing. They follow media influencers and social headlines, deploying their capital only after the gains are secured, treating a technological revolution like a lottery ticket and entirely missing the mechanical foundation of the wealth transfer. The passive consumers treat the digital markets exactly like a casino. They blindly hand their fiat currency to centralized exchanges, hoping that a mysterious algorithm will artificially pump their bags without ever understanding the underlying code securing the network. But the individuals who escaped the rat race understood the mathematical mechanics of the system. They recognized structural shifts and positioned themselves early, using the network as a mechanism for permanent wealth extraction. The producers treat the digital markets like a sovereign state. They build the bridges and write the execution scripts. They supply the liquidity to automated market makers. And they collect a strict percentage fee on every single trade. They stopped consuming content and started producing value running nodes and writing code and tracking ledger data, building the infrastructure that the herd would eventually use, and capturing the equity before the global banks arrived. Here's the unvarnished breakdown of 5 specific assets that transferred millions of dollars to the working class and the exact mechanical strategies driving those gains. The first asset is the king of digital scarcity, the original asymmetric bet of the 21st century known across the financial landscape as Bitcoin, the network that initiated the global rebellion against fiat. Early adopters were not simply buying a speculative coin. They were participating in a global mathematical competition where computers act as independent auditors and digital miners, securing the network through raw physical energy consumption. The network functions entirely without a central bank or president relying entirely on mathematical cryptography and consensus rules where miners trade physical electricity for digital block rewards, securing the ledger against any sovereign military or government. The brilliance of the proof-of-work algorithm is undeniable. It forces validators to burn resources in the real world, anchoring the digital economy directly to thermodynamic reality, and making it financially impossible to falsify the transaction history by understanding the consensus mechanism. Pioneers like Eric Feynman and Christopher Koch took action turning pocket change into multi-million-dollar fortunes before the mainstream public even knew what a ledger was. They did not buy their assets on a mobile application. They downloaded the raw software and mined the blocks themselves, trading electricity and processing power for foundational equity, operating in complete obscurity, while the legacy system laughed when early pioneers recognized this fundamental architecture. They accumulated equity while the asset traded for pennies, ignoring the ridicule of traditional academic economists and securing their positions before the block rewards halved. They understood that the cryptographic hash algorithm required machines to solve complex, unyielding puzzles, and the network rewarded this physical labor with pristine digital property, capping the supply at 21 million coins. The mechanical play here relies entirely on early adoption, acquiring technical assets when they remain deeply obscure and completely ignored by the mass of retail consumers, holding the equity while the market builds the infrastructure. When global institutions finally recognized the mathematical reality, the original pioneers had already secured their generational wealth, because the greatest returns in financial history always flow to those who build the foundation before the crowds arrive. The second asset completely redefined the boundaries of the technology, while the original digital asset proved decentralized. Money could function. The second iteration proved you could build an economy on it, introducing the world to the network known as Ethereum investors who participated in the initial coin offering in 2014. Were actively funding the decentralized infrastructure of the future, purchasing the underlying code that powers smart contracts and building the foundation for decentralized finance. They recognized that a ledger could do more than record balances. It could execute complex, unyielding mathematical agreements, removing the human middleman from lending and borrowing and trading, and shifting the power directly back to the individual user. The innovation of the smart contract changed the global economy, allowing 2 anonymous parties to conduct complex financial business without ever requiring a trusted third party or corporate lawyer, because the code executes exactly as written upon meeting the conditions. This enabled the creation of decentralized lending protocols where users deposit capital and earn yield without a bank, and decentralized exchanges where assets swap instantly on-chain, generating massive fee revenue for the protocol infrastructure by introducing a Turing-complete virtual machine. Developers could launch independent applications directly on the chain, spawning billions of dollars in volume across automated market makers and creating the structural backbone of the modern digital internet. The investors who funded the initial coin offering understood this vision. They knew that a programmable ledger would absorb global finance, and by securing the native asset required to operate the machine, they taxed every single developer building on the foundation. The strategic play completely shifts from holding to infrastructure betting, investing heavily in the digital picks and shovels of the market rather than attempting to trade the volatile applications built on top of it, capturing value from every single transaction that crosses the network. The asset acts as the mandatory digital oil for the ecosystem, meaning users are forced to burn it to execute their contracts, creating a perpetual demand loop that rewards the early holders while the late consumers burn their capital, executing trades. Those who identified this transition from currency to compute power secured equity in a global, decentralized supercomputer, extracting continuous revenue from the developers and the users who were mathematically forced to pay gas fees to operate the machine. The third asset weaponized the concept of global attention operating in a financial landscape driven entirely by human focus. An asset that explicitly started as a satirical internet joke known across the globe as Dogecoin. It generated wealth that shattered traditional valuation models, because viral psychology entirely outpaces fundamental corporate earnings, proving that liquidity does not care about balance sheets. It cares exclusively about the velocity of the cultural narrative. The modern attention economy functions on strict reflexive principles. When an asset generates viral momentum across social platforms, the rising price attracts more human attention to the network, which in turn drives more capital into the liquidity pools. The original creator of the token lacked the producer mindset, selling his entire allocation years ago to buy a used car, missing out on hundreds of millions of dollars in wealth, because he viewed the network as a joke rather than an instrument. The traditional value investors completely misunderstand this dynamic. They analyze cash flows and revenue models and balance sheets, while the producers analyze search trends and social media sentiment, capitalizing on the human desire to belong to a digital tribe. But investors who understood the mechanics of the attention economy turned a dog meme into life-changing liquid capital, holding their positions through extreme and violent market volatility to watch their digital portfolios cross the $1 million threshold. The most famous example, known as Slum Doge Millionaire, completely refused to sell during the algorithmic dips, understanding that the global sentiment generated by tech billionaires would inevitably drive the retail herd into a buying frenzy. He ignored the fundamental analysts who called the asset worthless, and trusted the momentum of the crowd and the influence of billionaires, extracting massive liquidity from the late buyers, chasing the hype and proving that attention is a measurable commodity. The mechanical play requires mastering global social sentiment, recognizing exactly when market psychology and viral momentum outweigh traditional financial metrics and Wall Street fundamentals, and aggressively front-running. The inevitable retail consumer panic wealth is no longer strictly tied to quarterly corporate earnings. It is tied directly to the velocity of global internet culture and traders who weaponized that raw attention, extracted millions from the traditional investors who laughed at the joke. The fourth asset solved a critical engineering bottleneck as the primary decentralized infrastructure became congested. The massive gas fees paralyzed the ordinary retail user, and the market desperately demanded a faster alternative as the original smart contract network reached maximum capacity. The cost to execute a single trade skyrocketed to unacceptable levels, pricing the working class entirely out of the decentralized economy and creating a massive structural vacuum in the digital market. This network, known as Solana, stepped into the void, operating with massive operational throughput, theoretically processing tens of thousands of transactions per second and dramatically lowering the barrier to entry for the working class. Solana entered the arena with a monolithic architectural design, optimizing the hardware requirements for the network validators and processing data across thousands of parallel execution threads, driving the cost of transactions down to fractions of a cent by engineering a novel consensus mechanism called proof of history. The blockchain mathematically stamped time into the ledger, allowing validators to process data without waiting for network consensus and shattering the speed limits of the original cryptographic architecture. This architectural pivot attracted a massive wave of high-frequency traders who utilized the speed to execute complex arbitrage strategies, and the early investors who backed the technological solution rode the adoption curve as retail capital flooded the ecosystem. Those who identified this structural shift early in the cycle rode the asset from single digits to over $200, capitalizing on the mass migration of developers and on-chain traders who simply wanted a network that functioned without friction. The specific play involves identifying critical structural bottlenecks, finding the exact point where existing systems fail and backing the most viable technological solution. Before institutional money realizes the migration has started, the engineers and early traders recognize the speed, premium understanding that capital flows directly toward the path of least resistance, and by positioning themselves at the foundation of the new highway, they successfully captured the wealth of the fleeing retail masses. The fifth asset represents the modern frontier of overnight wealth, operating with ruthless efficiency and extreme volatility, where anonymous traders utilize frictionless, decentralized exchanges to turn literal pocket change into multi-generational fortunes. The specific token known as Peanut, the squirrel, was driven entirely by viral social chatter and political outrage, representing the ultimate high-risk extraction mechanism, where network speed and on-chain analytics dictate the winners. The modern memcoin token launches on a mathematical bonding curve, meaning the price increases exponentially as liquidity enters the pool, allowing early buyers to secure massive allocations for minimal capital, before the token graduates to a decentralized public exchange. An anonymous trader turned an initial $16 investment into an estimated $3 million in pure profit by buying the obscure asset on a decentralized launchpad. And holding through the chaos as global figures amplified the narrative. They utilized the precise mathematical curve of the deployment, purchasing the asset immediately upon network execution and leveraging the viral news cycle surrounding the political event to watch the token valuation skyrocket into the billions. They monitored the on-chain wallets of the centralized exchanges, waiting for the exact moment the major platforms announced a listing, and aggressively sold their tokens into the massive retail demand, securing millions of dollars in untraceable commercial profit. They dumped the tokens when massive centralized exchanges listed it, navigating liquidity pools and extractable value bots, tracking smart money wallets and scanning block data in real time to successfully front-run retail buyers on major platforms. This proves that the blockchain is an uncompromising player versus player environment, where the absolute play requires mastering network speed and data tracking, monitoring the flow of capital in real time across the blockchain, and front-running retail consumers before they click buy. The traditional financial elite despise this decentralized arena because they lack the ability to control the outcomes. But independent producers who build the tracking algorithms continue to siphon millions from the system without asking permission. When you analyze these 5 historical wealth transfers, you realize they share a fundamental mechanical architecture. They were never about blindly guessing the next winner. They were about identifying systemic inefficiencies and exploiting them. The consumers consistently arrive late to the financial party, buying the assets after the media announces the record highs, while the producers operate quietly in the obscure shadows, building the infrastructure and accumulating the equity early. They do not beg corporations for a minor salary increase. They deploy smart contracts and secure public ledgers. They audit the code and track the digital footprints of capital, becoming the architects of their own financial liberation to escape the exhaustion of the corporate money trap. You must abandon the passive mindset of the consumer and start analyzing global markets like a structural engineer, looking for the mechanics that drive capital from the herd. If this breakdown of the assets that minted overnight millionaires and the reality of how producers extract wealth from consumers fired you up about taking total control of your permanent financial architecture, then do me a favor. Right now, smash that like button to let the algorithm know this factual historical conversation matters. Share this video with every friend and family member. Who needs to understand how the real financial world operates? Let us keep exposing the true mechanics of wealth and power. I will catch you in the next one, where we break down the next hidden chapter in the long history of money and corporate authority. Until then, stay informed, stay skeptical, and remember that the greatest fortunes in the history of the world are never built by following the herd. They are built by running it.